Welcome to this session of in Chapter 10, we're going to be talking about capital budgeting. Now, when we talk about capital budgeting, we're actually talking about the method that we use to justify the acquisition of what are called capital goods, those items that have a useful life in excess of 1 year. And these decisions are regardless of whether they wind up on the balance sheet as a fixed asset or they wind up off the balance sheet as something like an operating lease. There are still significant decisions that go into play with respect to the acquisition or the justification for entering into the acquisition of these kinds of assets. We're going to make certain assumptions here. We're going to make an assumption that these long-term assets generate increased cash flow by improving efficiency and effectiveness. Otherwise, the question is, why are we going into this particular transaction? And we also make assumptions that the rates of return on investments and current inflation rates will remain the same. And that's just an underlying assumption that you have to make with respect to just decisioning itself, even though you know that there is a risk associated. In fact, there's just a recognized reality that rates are going to fluctuate, and sometimes the return on investments and current inflation rates will go up or go down and not necessarily in tandem with each other. There are certain factors that are going to affect capital budgeting, of course. Changes in governmental regulations, for example, tax changes, can have significant impacts on capital budgeting decisions. Research and development, as new products, new ideas, new technologies are released and come out. And also just some changes in business strategy, whether it's a change of geographical location, a change in product emphasis, a change in marketing strategy. Any of those kinds of things can affect your capital budgeting decision. Now, today we're going to really be just talking about the 5 steps in capital budgeting and looking at these in a little more detail. The 5 steps involved in capital budgeting, of course, is formulating a plan. And a proposal. And this is going to be really going through, as we're going to understand here, it's identifying the costs and the benefits and what the cash flow of those costs and benefits are after tax, of course. We're going to evaluate. Step number 2 is evaluate whatever the data is that you've accumulated. Make a decision, number 3. Number 4 is to do follow-up, and number 5 is to take corrective action. So let's look briefly at just some of the component pieces of step number 1 of formulating a proposal. First of all, you're going to pull together what the costs are in your capital budgeting. This will include your startup costs, your working capital commitment costs, your tax factor costs. Understanding all of those pieces flow into whatever the particular individual component pieces are that you're going to make, that you're going to determine whether you want to implement and be a part of your business plan in the future. You're also going to want to understand what the benefits are. In other words, if you are making a decision to incur the cost to acquire a piece of equipment, a piece of land, a building itself, theoretically, there are benefits to the business associated with that. So what are those benefits, and how do you quantify those benefits? For example, you might be investing in some equipment that you are anticipating increased efficiency coming out of that. Well, what are the cost benefits what are the dollar benefits associated with that efficiency? You have to be able to identify that. You have to understand what the reduction is going to be in taxable income. And what other tax factors that are going to come in with respect to benefit. And you have to understand how just the depreciation, the write-off of that is going to be. And as part of that, understanding that there might be a difference between what you book for accounting purposes versus what you are allowed to declare for tax purposes. And so those are important items to understand and to factor in pulling together the proposal that you're going to have. Once you start to pull those costs together, then you're going to evaluate the data, which is step number 2. And we're going to spend most of our time today really just talking about the 6 methods that can be used to evaluate the capital budgeting process. And you'll notice here that most of these methods really kind of harken back to what we've just talked about in the previous couple of chapters of taking into account the time value of money. Because looking at the time value of money and the whole concept of how you crunch those numbers become an important part of really determining capital budgeting proposals. So there's 6 different methods that we're going to look at here that are listed. And so let's just talk about these methods one at a time. The first method is the payback method. And the payback method basically deals with the number of years that it will take a business to get back the money that it has invested in a project or an asset. And you can just see arithmetically here, it's just the cost of the project divided by the annual after-tax benefit of the project. So let's say, for example, a project is going to cost $100,000, and you may, after going through and figuring out some of your numbers, you say after taxes we get a benefit to our business of $10,000 per year. Well, 100,000 divided by 10,000 means that it's going to take us 10 years to get the payback for that. Now, the advantage of this particular kind of method is it's relatively simple to calculate. It's simple to explain, to understand. The disadvantage is that it doesn't take into account at all the time value of money, and there's also a disadvantage is that if you have projects that aren't exactly the same underlying cost project, it has a tendency to emphasize a quicker payback, and which may or may not always equate to the best business decision based upon what your business strategy is. This kind of method is particularly helpful if you are looking at shorter payback periods, because shorter payback periods don't have a tendency to have as much emphasis on the time value of money itself. And so it really allows you to look at projects that may or may not have the same kind of upfront investment, but they also are, the question is going to be, is one is a payback in 2 years versus another that is a payback in 3 years. So that's method number 1. Method number 2 starts to get a little more technical. This is the net present value, or NPV method. This again is a method of capital budgeting using the time value of money by discounting what those future benefits are and what the future costs are going to be, and discounting them back to the present. It applies the present value of a stream of payments technique for cash flows that come in on an even basis, if you're assuming that the benefit is equal, and the present value of a future lump sum technique for unequal yearly cash flows. So again, what we've learned in the last couple chapters, of chapters 8 and chapters 9, about how to figure out the time value of money, you can apply those things to what you think the benefits are going to be, whether they're equal benefits or unequal benefits for those cash flow streams in the future. And the calculations are made for this method using an interest rate that matches our cost of capital for the investment, which we'll talk about in a minute. And this rate is used because the company must pay this cost on an annual basis to obtain whatever the capital is that's necessary to make this investment. So there are really 2 interest rates as part of that cost of capital we must consider. The first one is that which is charged by the supplier of the funds or the lender, usually a bank or an equipment leasing company or other kinds of lenders like that. And then the interest rate that you as the borrower could receive by investing in some other enterprise. This is what we refer to, going way back into a previous chapter, in the early chapters where we talk about our opportunity cost itself. So let's look at the component pieces that come into play with respect to a lender who is going to be the interest rate that they're going to be charging us. They're going to be really looking at 3 different factors. One of them is what's called the real rate of return, the return that will be received after factoring out inflation. So they're going to make certain assumptions with respect to inflation, which is number 2 component. So it's what they think is going to happen with inflation during the term of the investment. So a bank is going to make, if you have a 3-year loan, they're going to make certain assumptions that they factor in to the return itself as to what's going to happen with inflation or deflation, up or down. Usually they're going to assume it's going to be going up. Then the third component is just the risk premium. This is the premium that's added to whatever the base interest rates are to take into account the risk of the investment. And at the end, in chapter 9, I talked about this briefly in my lecture, where I talked about that any bank, depending upon what the credit worthiness and the credit ratings are going to add a risk premium. And so if I as an individual have a poor credit rating and you as an individual have an excellent credit rating, you are probably going to pay on these kind of business loans, you are going to probably pay a lower interest rate than I am, because I am a higher risk, and so there will be a higher risk premium that's associated with this transaction that's going to be added into this transaction itself. Now, one of the terms that's out there that you have to take into account is what is called the cost of capital, or here they're calling it the weighted average cost of capital, which is obtained by multiplying the cost of the debt that you're going to be incurring with the bank or somebody else by the total proportion of the funds raised, and multiplying that by the cost of equity, which is your opportunity cost by its proportion of the total funds raised. And you kind of read that and you go, say what? And so let me just walk you through an example here. The example is you're buying a piece of equipment for $100,000. For that $100,000, you're going to put 30% of it down, $30,000 down, and then the remainder of it you're going to finance. You're going to finance through a loan, you're going to finance through some sort of capital lease or other kind of lease or some other way. So just definitionally, your opportunity cost is 4%. And what that 4% is, just to let you know, is just something that we're going to be just defining as what you could have invested in something else. For example, if you could have taken that $30,000 and instead of putting it down on an equipment, you could have gone out and invested that $30,000 in government bonds. Maybe you could have received 4% on that money. So that opportunity cost then comes into play for that 40%. And we're just going to just say, for example, that your bank loan is going to be 8.75%. And the factors going into that bank loan would include those component pieces that we just talked about on the last slide itself. So how do you use that to come up with a weighted average cost of capital? Well, again, don't get too hung up on all of the calculations here. But what it's doing is it's taking the proportion of what you have put down and comparing it to the proportion of what you're going to be financing. So the numbers are real easy here. If you're putting $30,000 down on a $100,000 piece of equipment, that's 30%, and you're borrowing 70% on that. So what you're doing then is you're taking proportionally, you're taking what your cost of equity is, which is on your 30% times 0.04 or 4%, and you're adding that to what you're paying on the 70%, times what the debt cost is for that debt loan of 0.875, and you're coming up with a weighting of those two different rates out there to come up with what your weighted average cost of capital is, or which here in this example is 7.33%. Again, the 0.04 is the 4% opportunity cost of what you could have gotten on those funds instead of paying them out of your checking account, or really which is out of your equity. You could have gotten someplace else versus what the bank rate is. And that is going to be the rate that you're going to use for your net present value calculations itself. Now, when we look at the net present value, what we're really doing is considering all of the future cash flows of that asset over the entire economic life of that asset. So what you're going to be doing is you're going to take what you have identified as the benefits of those assets is, again, this is after-tax benefits, and when those benefits are going to be received over the life of the asset. So if it's, let's say it's 10 years, you have kind of calculated out differences there. So apologize for the dog barking at the door. We had a delivery at the front door. So again, picking up where I left off, is you're going to be looking at the cash flow of the benefits over the next 10 years, whether those cash flows come in on an equal basis or they come in at different amounts throughout the years. You're going to present value that and back to the current date. And then you're also going to do a calculation of the present value of what the cost of the investment is. And again, that is going to be looking at the net cash flow of your payments and the payment on the loans that you're going to be using, and that then is going to allow you to come up with a net present value on the initiative itself, and then you can start to make a decision using this methodology. Because once you do that formula, if the benefits are going to minus the costs, again the net present value items, if it's positive, then the investment decision is a positive decision. It should be made, or it should be considered to be made. If the net present value is negative, then it basically means that the investment should not be made. And this particular methodology has two primary advantages in using it. First of all, the future cash flows that will be paid and are going to be received, both inflows and outflows, can be discounted back to the present, so that a decision on the investment can be made now. And it also means that interest rates are determined based upon the weighted average cost of capital that takes risk into consideration, the risk that's built into the bank loan, but it also takes into account the risk or the opportunity cost of what it costs you to pay for a portion of it out of your pocket. Now there are some disadvantages to this too. And the disadvantages, again, as I mentioned before, if the interest rate estimates are too low, then you're not going to get a good answer here. Or if the cash flow of benefits are going to be too high, or really you overestimated them, then of course this will give you a false answer with respect to whether or not you should proceed or not proceed itself. The third the third method of looking at where you want to go is and of course the other disadvantages. This can be kind of complex to work through. The third method is what's called profitability index, or PI. And what the profitability index is really taking the ratio of the present value of the benefits to the present value of the cost. In other words, those two numbers that you just calculated, and you came up with either a positive or negative number, what this does is this actually looks at the relationship between the two. And if you can understand here, if the PI is greater than 0, in other words, your benefits exceed your costs, then it's a project that you could potentially accept. If it's negative, you can reject. And again, this is just another way of looking at the net present value itself. And the net present value gives you an absolute number. This gives you a ratio. So if you're looking at projects that have different investment costs associated with it, this allows you to be able to compare two different projects that are really two different completely kind of projects, just to see what the ratios of those numbers are. Again, the disadvantages are the same disadvantages as net present value. An advantage, of course, is this is fairly easy. Once you have the base numbers, it's fairly easy to calculate. The fourth method that you can do is what's called IRR, or internal rate of return. And the internal rate of return is the actual rate of return of an investment and uses the time value of money in its calculation. The IRR is the interest rate that matches the present value of the cost of our investment directly against the present value of the future benefits received. So you may read that a couple times and go, huh? Well, let me just kind of walk you through the component pieces of this. The future benefits that they talk about there can be in the form of a stream of payments over a period of time or a lump sum salvage value received. For example, if you buy a truck and you're buying it outright, you're not turning it in at the end of a lease term or something, there's going to be benefits associated with, theoretically, to the business that you're going to be able to quantify, but also at the end of the life of that truck, you may be able to sell that truck for a salvage value. You can turn it in sell it for $2,000 or whatever the appropriate amount is. So you're going to be taking into account the present value of that stream. And the IRR is the interest rate that occurs when the net present value of these cash inflows and cash outflows is zero. And if the net present value is zero, then by definition, the present value of the cost must equal the present value of the benefits itself. So what you're really doing is calculating out your net present value benefits, which we've already talked about before, and you're calculating out your net present value of your costs itself, and then kind of trying to determine what is the interest rate that is necessary for those two things to be equal in assets, or the benefit is zero, and that by definition is your internal rate of return. So so you really kind of, there are ways that you can do this on a calculator or on Excel to kind of back into that, or you can kind of manually come up with a guesstimate on this. And let's just, again, which is the formula is here on the screen. Let's just let me just talk you through an example. Let's say you make a decision that you have an investment of $25,000 in a piece of equipment, let's just say. And the annual benefit that you're going to receive from that piece of equipment is, after tax, is going to be $3,000 per year for 20 years. And you sit there and you go, and of course, obviously, we're taking the easiest example here, depending upon how streams may vary, then of course the calculations become a little more complicated. But when the net present value of that $25,000 investment that you're going to be making minus the net present value, or the net present value of the benefit, minus the net present value of the cost, when that equals zero, that is your rate. So how do you find that rate? Well, manually, you can just take the $25,000 of investment divided by $3,000 of annual benefit, and you come up with an initial rate of 8.3333%. So now you're going to turn into the table in the back of your textbook, table B-5, and you're going to look, because this is for 20 years of what this benefit comes through, because it happens to be an equal benefit per year. You're going to go to the N equals 20 row, representing the 20 years, to find an interest rate, and to see which interest rate corresponds to that 8.333 number that you calculated. And you're going to see that in the column there that it's going to be somewhere between 10% and 11% is going to be your IRR. And then you can just kind of do a simple interpolation to try to figure out approximately in between 10% and 11% where that factor falls into play. And that allows you to kind of zero in on an IRR itself. Again, just understanding that how you get to that is important conceptually. You may or may not want to use something like that. At disadvantages, it starts to get complicated, and it's a little harder to explain to people itself. Let me just talk you through one more rate of return, which is called an accounting rate of return. This is the average annual income from a project divided by the average cost of the project. For example, the example we were just using, or a different example, you invest $10,000 and you receive royalties of $3,000 per year. You could just do a simple calculation, which is the 3,000 divided by 10,000 is 30% is your accounting rate of return. This obviously is a very simplistic approach, doesn't take into account time value of money itself. It is focusing just exclusively on the income stream that you're going to be receiving versus any sort of time value of that. And that's the biggest disadvantage of that. This also, you start to look at this as 30% rate of return, and that's really pretty unrealistic. So I'm just kind of mentioning this in passing. This is really not recommended, and I personally don't know of anybody who uses this really as a methodology of making these kind of decisions. The sixth kind of decision, or the last decision that I want to mention as to with respect to methodology, is what's called the lowest total cost. And what this is just the method of capital budgeting, which is similar to the net present value method because it uses time value of money, but it discounts future costs and benefits back to the present. And what this method does is it determines the lowest present value of the total cost as follows. You go through and you identify all the costs associated with two or more competing investments. For example, let's say in the textbook uses the example of trucks, which is an excellent example, is you're looking at two different kinds of trucks that you want to buy. These trucks have pluses and minuses associated with them. Some of them are higher cost, others are lower cost of the trucks themselves, but some of these trucks over the life of the truck have higher maintenance costs, lower gas mileage costs, a different insurance cost, all of these kinds of things. So you're going to go through and you're going to determine what the net cost of running that vehicle is per year. And then you're going to present value those costs back. And then you're going to add the benefits that you may have, including back-end salvage costs that you may get from that. Some trucks may be a little bigger, so you may have a little more carrying space, and so that has a better income benefit, even though the truck might be more expensive. So you go through and you pull all those things together, and then you net present value that back to try to identify which of those trucks with these competing pluses and minuses actually bring you the greatest benefits themselves. So as you're going through this, step number 3 in the process itself is making the decision. The methods previously discussed are often used in making a capital budgeting decision. However, there's also 2 other scenarios that exist that I want to just briefly mention. You look at these additional scenarios, there's 2 scenarios here. One which is called a mutually exclusive scenario. Some investments are mutually exclusive because once you choose one, the others are automatically either sacrificed or excluded. For example, if you're looking at making decisions with respect to a retail side investment and you're looking at 9 different locations, and you only have enough money to choose one, once you make the choice of whichever one you're going to go with, just by definition, the other 8 then are not going to be chosen. And that kind of then comes into the second kind of scenario, which is called capital rationing. And capital rationing means that there's just a constraint on what you can do. For example, if you're going back and purchasing trucks and you're looking at 7 different kinds of trucks, but you only have enough funds to be able to buy 2 of the trucks, even if 5 of the trucks have a great return and they come out with respect to just they would be positive decisions to make, you're only going to be choosing 2 of the trucks because that's all you can afford. So again, those are some other scenarios that will come into play with respect to constraints that happen on a budgeting decision itself. Step number 4 on capital budgeting is obviously the follow-up, which consists of monitoring and controlling the cash flows. And the textbook refers to this as a post-audit. Whether you call it a post-audit or it's just going back and continuing to go back and reevaluate what the decision is, you're going to want to have procedures that are in place that really tell you how well that initial decision correlates with whatever you thought was going to happen. And as we've talked about before, just controlling and managing your business is a 3-step process. Establishing standards, measuring your actual against what the standards were, and then taking corrective action, making any adjustments that are necessary, which actually is step number 5 in the capital budgeting process itself. As we've kind of looked at pulling together all these component pieces, in the next chapter, chapter 11, we're really going to kind of be stepping back and looking at how adequate the strategies are that you have to put into place that should be considered in both personal finance and in the small business decisions that you might be making. And both of these are really kind of a summarization of those things that we talk about in much more depth in the business finance class 205, the personal finance class, and also in the small business entrepreneur class, the business management 210 class itself. In the business management class, business management 210, we actually get into component pieces of pulling together some of these business evaluations and plans, primarily outside of the financial considerations, even though that is covered also. So we'll be kind of touching on that in Chapter 11 to give you a taste of it.